Welcome back to Squawk. I'm Bruce Whitefield. It's no secret that your key to growing your wealth is to invest your money wisely as early as possible. However, making the decision of how much to put where and how often and at what point is a daunting task for many, not even first-time investors. Every single investor should be grappling with these issues every day, developing a pretty meaty ulcer in the process. If you don't have an ulcer, you're not thinking hard enough. Tonight we pose the question to our guests. What must you avoid? Not what must you do. What must you avoid? Because people keep telling us what to do, we don't do it. So tell us what not to do. And then at least we can not do that and we'll be better off.
Well, first of all, Bruce, I think the first mistake that most investors make is they don't have a clearly thought out or credible plan. And that's really the foundation of any of this.
So avoiding the plan.
Avoiding the plan. I mean, you've got to ask yourself the hard questions. A lot of people don't have a fundamental understanding of what their ability or risk tolerance is. So first of all, understand what you want to achieve, and then you can build a credible plan or a roadmap in terms of how to get there.
But how does Joso build a roadmap without going to a financial advisor who's going to try and smose them a poorless?
In fact, that's the point I was going to make as you started this introduction, because the biggest mistake I made was about, when did the internet bubble burst? 2000. Shortly thereafter, I had some pension money and decided to give it to a well-known broking firm, international broking firm. And I thought they had grey hair, they would know how to handle it. And the problem is I never had belief in my own instincts and my own understanding of the market. There was always someone who knew better than me. What happened, I gave them the money, and within a short period, because I wanted a balanced, remember interest rates were fairly high at that stage, I wanted a balanced portfolio. What did they do, these geniuses? They put it into tech. And within a few...
Because tech had enormous value.
It was coming down, you know, it's now you average all the way down. Another important rule. Killed more people than any war. And Bruce, what happened is that literally I was in a balanced account, and this is the worry, that as my equity portfolio went, they rebalanced by selling the bonds which were holding down. And I said, you know, I went across to London, and here were these chaps. There's an expression, you know, they were going to Cheder. Cheder is Hebrew school. You know, it's a way we say they went to Cheder on my pension. They went to school on my pension. And these were all Wharton and so on, you know, all from the best business schools. And I said to them, and this is the important question, I said to them, you can lose my pension. That's my downside. What's your downside?
Yes.
No downside. I said, listen, my downside is you can lose my pension. What's yours? They had no answer for it. They were still charging me fees on the way down. So the lesson is you've got to take control of your own finances.
But how do people do
Learning
that?
and reading.
Education.
Education. You've got to, don't put your portfolio in the hands
we're
of...
learning, we're learning from your bitter experience. But here's somebody like yourself, David, who just 12 short years ago, with 30 years of experience behind him, at that point, still didn't trust himself how to do it properly.
That's the problem. Trust your instincts, because instincts are based on information that you gather over time. And when somebody comes to you with a fancy product that you don't understand, say to them, I don't understand what you're talking about. You know, please explain.
Ask the questions.
Ask the questions.
But people don't know which questions to ask. So I don't understand is a terribly vulnerable position, and you feel that somebody will take advantage of you if you acknowledge that you don't understand what's going on.
As David correctly said, is they're arguably taking advantage of you already. So by not asking the question, you're in the worst of possible scenarios. And like David says, correctly so, sometimes go with your gut. If your gut's telling you the smell's wrong.
I delayed a retirement strategy for 10 years because I went in short succession to go and see three brokers that before the financial planners were in the fall. And I was so put off and so mistrustful because they wouldn't answer the simple questions. That you then, you go and do other things, but you're not investing for the long term. And to this day, I'm furious at myself for not being more proactive. So it's taking, you're the one who's going to suffer in the long term. You know, they're going to be sitting on a beach in the Bermuda because of the fees that they've charged you, thanks very much. And you're the one who's going to be sitting...
when it comes to your health, you'll make the right decision.
Well, I hope so.
When when you go to a doctor, you say, I don't like this man, whatever it is. So when it comes to financial health,
would you not
do the same thing?
Okay, now that's a good advice on what to do, what not to do. So don't avoid the financial plan. Okay, give me another one.
Well, what not to do is
don't trust anybody. That's a good one. Yes.
The other thing is don't get swept up in the noise of the market. You know, I think a lot of people, once you've established that plan and you know this is how I'm going to get there, you do your homework. So there you go. You ask the questions, you do your homework. And then getting caught up in the noise is actually very easy, and it leads you to make bad decisions. So you end up buying too high, selling too low, not applying a discipline. I'd like to say maybe applying a discipline once you've formulated a plan is probably one of the other very important things.
That's actually, yeah. That's, you know what happens? Don't box yourself
David's
in.
finally got it.
I was trying to think.
How many years have you been in the market?
Don't box yourself in.
But you know what's so refreshing about this is that you, as somebody who's been in markets for a while now, since you're how old? 20?
It's 41 years.
41 years. So
42 years.
You've been in the market longer than he's been alive and nearly as long as I have. And you still have this level of insecurity about your own money.
Yes.
You'll manage other people's money. You win 2 Raging Bull Awards. Thank you very much for managing other people's money, but you don't.
You know, look, that's how long it took me to learn.
Yes.
40 years. And you know what happened with that Raging Bull? Because the initial stages when I started to manage other people's money, you know, I get caught up in the noise. Now I've got my own plan. I buy quality companies, sustainable, understand what they're doing. Funny enough, you suddenly realize how clever a man like Buffett is.
Yes.
You know, when you read what he does, you say, you know, he's actually quite clever. And if you follow principles that he's given, you know, which is really pursuing companies that you understand, where the product you understand what they do, etc. Valuation is important. You know, you've got to know when to do it. But don't get caught with all these different kinds of products which promise you things that they will never deliver.
Bold honesty this evening here on Squawk. Yeah, there's a book out at the moment, Buy High, Sell Higher. Warren Buffett's an idiot, so basically the subtext. So I'm looking forward to reading the book because I'd love to challenge the author. Okay, now let's have a look at some of the big winners over the last 5 days. Hardly surprising that there's been a bounce back in construction shares, very strongly so. Good slap on the wrist, quite an expensive slap, but a slap nevertheless. Could have been much worse. Murray & Roberts up 7% in the week. Aveng up about 4%. Also gains for Grindrod, PSG and ArcelorMittal. One we haven't spoken about on the show for